You're about to watch the best trading analysis video of what is likely to happen in 2023 in financial markets. This analysis comes straight from institutional trading floors where I spent most of my career working, so it will be stuff you are not going to find anywhere else. So put that seatbelt on, strap yourself in for a literal trading journey like no other. Now, given most videos on social media are using random chart patterns and arbitrary support resistance and Fibonacci lines that belong in the 1800s, I don't really have that much of a benchmark to beat. But in all seriousness, as you will see for yourself, the analysis you're about to witness is what elite traders at the very best banks and trading firms in the world are looking at, and that will become apparent very quickly. You'll also see how I not only made some serious money from this analysis, but how you can also start incorporating it into your trading in 2023. Now, before we begin, given it's my first video of 2023, I feel it is really important I make the following point. Would you agree some of the most popular videos on YouTube are those that talk about the habits needed to become successful? Whether it's the video creator or trader themselves telling you the habits or mindset needed to be successful, or what seems to be the latest YouTube craze. The truth is, watching all these videos is great entertainment, but at some point you actually need to start doing the work. And that is what we are going to be doing today, the work. So if you are serious about your trading, be different. As painful as it will be, make 2023 different. Force yourself to look through what I am saying today right to the very end. As uncomfortable as it may be, you already know the habits needed to be successful. Let's do some work and get you thinking the same way the very best traders in the world do. So first off, if 2022 was all about inflation, there is no doubt that 2023 will be all about economic growth or lack of. Now, whilst the Federal Reserve has a strict mandate to control inflation, and judging by the recent rapid increases in interest rates, they are clearly focusing on that heavily at the moment, the reality is, whilst they may not outwardly admit this, they are constantly balancing price stability with economic growth or the economic prosperity of the population. Now, usually inflation and economic growth can move together in tandem at healthy, moderate levels, and everyone is happy. But when one gets out of whack, as we have seen with inflation in the past 12 months or so, bringing it back under control by raising interest rates can have a very negative impact on economic growth, as we are very slowly starting to see now. Before we get into how institutional traders such as myself use this information to make real money, let's come up with a base case scenario for markets in 2023. Now, 2022, as we've already said, was all about inflation or price rises. You don't have to have an interest in macroeconomics to know that prices were rising at their fastest rate in many decades. You simply had to go to the shops and it was obvious. Now, for our purposes, we are more interested in how this impacted markets, as that is what we are trading. And the bottom line is, it had a devastating impact on markets, with US equity markets experiencing a near 20% decline in 2022, the fourth worst year for the index since 1950, and the worst year since the housing crisis of 2008. Now, the one thing that is severely misunderstood is just how much of an impact or spillover this has had on other markets. As always, you don't need to take my word for it, just look at the facts in front of you. Here, you can see crude oil, Bitcoin, and equity prices over the past 12 months. Federal Reserve action, i.e. interest rate rises, and its subsequent impact on equity markets and other areas of the economy has spilled over into all other markets as highlighted here, with significant declines in crypto markets such as Bitcoin and also crude oil. So it doesn't matter what you trade, to do well in this business, it's crucial you understand what we are talking about today. So back to the analysis. The interest rate hikes we witnessed in 2022 are starting to have an impact on inflation, but at a cost. The rapid hikes in 2022 are working with a lag on the economy, and now finally, as we head into 2023, starting to show up in some economic indicators such as housing, for example, where mortgage applications are at 25-year lows. In addition, crucial leading economic indicators such as the ISM surveys are also experiencing weakness, with the ISM Services Index just registering its first contraction reading since May 2020. So to summarize, the interest rate hikes are working as evidenced in headline inflation, which is steadily dropping, and core inflation, which is finally moderating, with further declines expected in 2023. However, can you see the price we have had to pay for this moderation is through a hit to economic growth? And this is likely to now be the main recurring theme throughout 2023. Can you see the shift from a focus on inflation in 2022 to economic growth or lack of in 2023? So expanding on that further, the key question on every professional trader's mind in 2023 will be how bad will economic growth suffer this year in order to get inflation to come back down towards the Fed's long-run target of 2%. Now that we are seeing some moderation in prices, in 2023, the focus will shift more towards the potential damage these rate hikes will have on economic growth. It doesn't matter what you trade, equities, crypto, oil, or even currencies, to understand where your market is going to go in 2023, you need to have a view on how badly you think economic growth will be hit, if at all, in 2023. And that means doing some work. Now, fear not, as we're going to do the heavy lifting together. First, let's come up with a base case scenario for growth and then relate that to how it will likely impact markets, and then you will also see how I made money from that view this week. Now, my personal prediction is that whilst the odds are high that a recession occurs in 2023, I do expect it to be mild. And as you're about to see, this does seem to be the general consensus amongst institutional traders, and given they are the ones moving the market, it seems a no-brainer to start aligning ourselves with them. So let's look at the data. Both ISM indices, which are highly accurate leading indicators of the path of demand or activity in the economy, are now in contraction territory. Virtually every time these surveys have contracted historically, this has been followed by weak economic activity. So the odds are that we will see a slowdown in GDP in 2023. But how much? Well, the key difference in this period of time compared to the previous recessions is the resilience of the labor or jobs market. One of the main reasons the Fed has been so comfortable raising interest rates so rapidly has been just how strongly the jobs market has been in the past year. To highlight that, if we look at the last 50 years, in the 6 months leading up to a recession, monthly job growth has averaged 99,000 new jobs per month. Whereas in the last 6 months of 2022, job growth has averaged 307,000 new jobs a month, over 3 times as much. The unemployment rate has also moved back down to 3.5%, a 50-year low. There is no denying the jobs market is solid. Compare that to the last inflation-driven double-dip recession of the 1980s, when the unemployment rate was between 8 and 10%. It was a dramatically weaker jobs or labor market than what we are currently experiencing. Now, whilst this doesn't mean we will avoid a recession entirely this year, especially given weak manufacturing and housing activity, it does mean we enter this year from a much healthier employment position compared to past downturns. And that matters. Why? Well, as mentioned a few times now, whilst key cogs of the economy such as housing and manufacturing are already showing significant signs of faltering in 2023, consumer spending should continue to be strong, supported by this resilient jobs market or employment backdrop we are seeing. If people have jobs, they have money to spend. It really is as simple as that. And with consumer spending making up 70% of economic growth, consumers are likely to provide solid short-term support to the economy as interest rates start to bite. So putting all of this together, if we do see a downturn in the economy in 2023, a much milder recession seems more likely as opposed to anything too severe. And if we couple that with the inflation outlook improving, this should be quite positive for not only stocks, but also all markets heading into the main part of 2023. So let's wrap it up with some hard numbers that back up our positive thesis, as this is exactly the type of stuff banks will be doing before they put their money to work betting on a soft landing in the economy. Now, given this more favorable downturn environment we have described, Would it be fair to say we are more likely to see a downturn in equity markets more in line with historical averages of around 25 to 30%, i.e. no worse than average? And given we've already experienced a minus 25% drawdown over the past 12 months, I think it's a good bet that this bear market is now in its latter stages. We are already seeing tentative signs of that the past few weeks as the market has failed to make new lower lows, exactly as I predicted in my last fundamental update a few weeks ago. It is therefore no surprise that I've been buying the market on a day trading basis this whole week, as you can see here, netting me some solid profits as we start 2023. This also highlights that even though I am an intraday trader, this positive sentiment I'm talking about in the fundamentals is influencing my decision making on a micro basis. Anyway, the point is, a lot of the negative news we've been discussing today has already been priced in 2022, hence the 25% drawdown in 2022. So whilst volatility is likely to persist as the market tries to second guess the next move by the Fed, the bottoming process may already have begun, and the rhetoric we have just described about a soft landing as opposed to a severe one is providing a lot of good support to the market in the past few trading sessions. And I think that's likely to continue into 2023. Institutions are clearly in agreement as they are currently using any weakness in the market to accumulate positions, and I've simply been piggybacking off the back of that. So 2023 should see a return at some stage to much healthier markets. So before we wrap up, let's look at some very last final pieces of hard data points that institutions will also be looking at to back up that base case scenario we have just presented of a more positive market in 2023. Firstly, back-to-back negative years for the index are unusual, only occurring 3 times since records began: World War II, the 1970s oil embargo, and the tech bubble. All quite extreme circumstances. Secondly, the market has bottomed in the first quarter in every one of the last 4 bear markets, suggesting Q1 2023 could also potentially be the bottom. And if that wasn't enough, let's look at data comparing the daily return progression of the S&P 500 for every year going back to 1950, and then run a correlation analysis comparing each year to 2022. What we will see is very few years have a high correlation to 2022. However, 1962 sticks out in particular. Not only does it have the highest correlation at 82%, but it also ticks the most boxes when we compare the 2 environments, i.e. 1962, just like 2022, had no recession, it had an increasing interest rate trajectory, and both years also experienced bear markets. Now, if we compare prices in 1962 to 2022 and extrapolate out into 2023, this would suggest a positive return of around 18% this year. In fact, if we take an average of all years that correlate well with 2022, we see the following year we saw an average of over 11% positive return. This all bodes well for 2023. Now, of course, there are limitations to using correlation and past data, but can you see? This is just a base case, and institutional traders like myself are simply stacking the odds in our favor, and the results speak for themselves. Now, if you're going to do an economic analysis, looking at data in the way presented today is what high probability trading is all about. Chucking some complete garbage, arbitrary trend lines, then combining that with where it meets some silly Fibonacci levels is not high probability trading, and I think I've proven just how many million miles away from that rubbish the analysis done by institutions is. Finally, I would also highly recommend combining fundamental analysis with order flow, something all institutions are using to achieve a real killer combination for your trading and to help make 2023 a killer year for you. I hope that was useful. For more of this type of analysis, check out this video here and the many others on my channel. Have a great 2023.